Listen closely. Cable just printed a lower high with hidden bearish divergence, and a 5% gilt yield is about to flush the pound to 1.3340. Below 1.3370, the support evaporates. The danger is a cascade of stop losses. The opportunity is the fake breakout trade that snaps back hard. Right now, as I speak, sterling is hanging by a thread. The pound is not just dipping, it's being systematically dismantled by a surge in gilt yields above 5% and a dollar that's sucking every ounce of safe haven flow out of the market. Most traders are looking at the same obvious support level and thinking it will hold. They're wrong. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the 1 headline that flips everything tomorrow morning. If you skip the trade plan section, you are leaving money on the table. Let's get into it. Here's your instant market verdict. The intraday bias is bearish, full fade mode. The trend on the 4-hour and 1-hour charts is a strong sell. ADX is running above 31. Momentum is accelerating lower, and every pop toward the 1.3400 handle is being offered aggressively. The single number that resets the entire structure today, write this down, is 1.3426. If we get a 4-hour candle close above 1.3426, the bearish sequence invalidates, and we pivot to looking for longs. Until then, the path of least resistance is down, and I will tell you exactly where the herd is positioned. Retail is still net long, holding on to a bounce narrative, and just below 1.3340 there sits a massive cluster of sell stops. That's the liquidity the institutions want. And just this morning, Rabobank put out a note flagging that funding worries for Prime Minister Burnham's agenda have pushed 10-year gilt yields above 5%, that is fundamentally strangling the pound. The market is pricing a fiscal risk premium into UK assets, and that shows up in a weaker cable. This is not a random drop, it's a structural repricing. Let's go straight to the chart and the technical deep dive. On the daily time frame, we had a beautiful ascending channel that defined the recovery from the June lows. That channel just broke. Yesterday's candle closed beneath the channel floor, and today the price is struggling at the 50-day exponential moving average around 1.3386. We are currently at 1.3378, right on the fulcrum. The moving averages tell a compelling story. The MA5 has crossed below the MA10, the MA20 is flattening at 1.3390, and the MA200 is acting like a magnet at this same 1.3378 level. That's a battleground. Below here, the next structural floor is 1.3340, a level that has held multiple times on a monthly basis. If that gives way, the measured move of the channel breakdown targets 1.3210, which also lines up with the next major swing low. Support stack, we have 1.3372 as the S3 pivot, then the 1.3340 horizontal base, then the macro floor down at 1.3210. Resistance is layered. 1.3400 is the psychological barrier, 1.3425 is the confluence of the broken channel line and the 9-day EMA, and the pivot point at 1.3442 is the ceiling. Now, drop to the 4-hour chart. Here's what most traders miss. They see the RSI at 49.8 and think no man's land, no edge. But the oscillator is giving a textbook hidden bearish divergence. Look, price made a lower high near 1.3426 on the last rally, while the RSI printed a higher high. That is hidden bearish divergence in a downtrend. It confirms continuation, not reversal. It tells you smart money is selling into strength, using the pop to reload shorts. MACD is flat but has just ticked below its signal line, and the histogram bars are printing red. The Williams %R at -60 is pointing down but not yet oversold, so there is room to fall. On the hourly chart, the picture is even clearer. A clean break below 1.3370 triggers a cascade down to 1.3340. Volume on the downside spikes is heavier than on the bounces. Every single rip toward the MA60 on the hourly has been sold. That's the rhythm. And cross-asset, it makes perfect sense. The dollar index is muscling towards 105. 10-year US yields are ticking up as crude oil spikes above $85 on the escalating US-Iran tensions. That geopolitical energy shock is stoking inflation fears, lifting real yields, and drawing capital into the greenback. The VIX is creeping higher, which historically correlates with a weaker pound. The pound's fate is tied to the gilt market. With gilt yields above 5%, the UK fiscal story is under serious pressure, and that's why sterling cannot sustain a bid even when the economic data beat, which it did yesterday. UK retail sales came in strong, yet the pound fell. That's a giant red flag. The market is trading the fiscal risk, not the data. Let's weave the fundamental driver and cross-linkage together. Over the last 24 hours, the core news is not just the Middle East escalation, it's the auction calendar. Today, at 12 p.m. Eastern, the US Treasury holds a 20-year bond auction. That's a huge liquidity event. If the auction sees weak demand, yields will jump further, and the dollar could rip, delivering the final blow to cable. Before that, at 9:30 a.m., we have EIA crude oil inventories. A larger draw than expected would send oil even higher, reinforcing the dollar safe haven bid and indirectly punishing the pound. So the 1 to 2 week directional lean is decidedly bearish. I am targeting 1.3340 initially, and if that breaks, 1.3210 comes into play. The event that invalidates this medium-term bearish view is a daily close back above 1.3520, that would negate the channel break and suggest a false breakdown. But that's far away. Right now, I want you to think about this interaction. Do you think cable breaks 1.3340 today? Comment yes or no. I'm tracking consensus right now, and I'll reference the community's read in tomorrow's video. This is the pulse of the market, and it helps you see if retail is still fighting the trend. Now we enter the most valuable part of this video. Most people skip this section. That's exactly where the money is made. Keep watching. I have 2 scalping strategies and 1 swing strategy, all with exact numbers, exact triggers, and exact risk-reward logic. No guesswork. Strategy 1, the opening scalp. This is a bearish continuation play designed for the London or early US session. The trigger is simple. We need a 5-minute candle to close firmly below structural support at 1.3365. That confirms the breakdown and triggers a flush. The entry is at the close of that 5-minute candle, so around 1.3365. Your stop loss goes 10 pips above at 1.3375, just above the minor consolidation zone. Take profit 1 is at 1.3345, right above the liquidity pocket, giving a risk reward of 1 to 2. If momentum is strong, you can hold a runner to 1.3340 for TP2. The scalp is void instantly if the next 5-minute candle closes back above 1.3375. That would signal a fake out, and you exit immediately. The opening SCALP entry, 1.3365, 5M candle close below, stop loss, 1.3375 take profit 1, 1.3345 take profit 2, 1.3340 risk reward, 1:2.0 R invalidation. Void if 5M candle closes back above 1.3375. Strategy 2, the liquidity grab. This one exploits the stop hunt that will likely occur right at the 1.3340 magnet. Here's how it works. The level 1.3340 is a huge psychological and technical flaw. The market will drive into it, likely puncture it by a few pips to trigger the retail stops, and then violently snap back. That wick is the signal. On a 15-minute chart, wait for a clear bullish rejection wick, a long lower shadow, followed by a bullish engulfing candle that closes back above 1.3345. That is your confirmation that the liquidity grab has succeeded. Enter immediately at the close of the engulfing candle, near 1.3350. Your stop loss must be tight, placed just below the wick at 1.3325, 10 pips under the low. Your target is fast, a singular take profit at 1.3365, the former breakdown level that now acts as resistance. This is a counternoise scalp, so you must be quick. If the wick goes deeper than 1.3320 without immediate rejection, the pattern fails. Warning. Requires fast execution and is only for traders who can manage tight risk in rapid moves. The liquidity grab entry, 1.3350, 15M bullish engulfing after wick below 1.3340, stop loss, 1.3325 take profit, 1.3365 risk reward, 1:1.5 invalidation, no entry if wick exceeds 1.3320 without immediate snapback. Now, here's your interaction cliff. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits, and I'll tailor tomorrow's focus based on the dominant style. Drop it right now. Strategy 3, the session swing. This is the high-conviction directional trade aligned with the 4-hour and daily bearish structure. We are not chasing. We are fading into resistance. The entry zone is the sweet spot between 1.3400 and 1.3425, a confluence of the broken trendline, the 9-day EMA, and the psychological round number. You can use a sell limit order at 1.3420 or wait for a bearish reversal candle on the 4-hour chart, like a shooting star or bearish engulfing, that confirms the rejection. Place your stop loss outside the daily structure at 1.3465, above the pivot point and the recent swing high. That's a 45 pip stop, which is well within a reasonable risk parameter given the targets. Take profit 1 is set at 1.3340, the immediate support and a conservative swing target. Take profit 2 is stretched out at 1.3210, the macro channel floor, which gives a risk reward of over 1 to 3. Once price reaches the halfway mark to TP1, around 1.3380, trail your stop to break even. The invalidation level for the swing trade is a daily close above 1.3465. If that happens, the bearish thesis is broken, and you exit without hesitation the session SNG entry, 1.3420, limit or 4H bearish rejection, stop loss, 1.3465 take profit 1, 1.3340 take profit 2, 1.3210 risk reward, 1:3.2 invalidation. Void if daily close above 1.3465 before we look ahead. A fast risk management pulse. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. No positions through high-impact news. And today that means the crude oil inventories and the 20-year bond auction. Stops are non-negotiable. This is how you survive to trade the next big move. Now, let's set up tomorrow. The single most critical level for the next session is 1.3340. If it breaks, the entire monthly uptrend faces a structural reset. Tomorrow's wildcard is the reaction to the US bond auction. If yields spike, the dollar will break 105, and cable could accelerate toward that 1.3210 floor. I'll have the updated blueprint 24 hours from now, with the exact levels that matter after the auction's dust settles. You do not want to miss that. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis, and then loop back to today's Nasdaq Gamma flip later. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. The big money is made not by predicting, but by being prepared. Scalp the noise, swing the trend.